thing. BPP practice kit, question number 17, Olivine. This is a question at the end of the book. A good basic fundamental question for valuation. It's a short scenario, so I will read it with you together, okay? So it says that Olivine is a holiday tour operator that is committed to a policy of expansion. The company has enjoyed record growth in recent years and is now seeking to acquire other companies in order to maintain its growth momentum. It has recently taken an interest in Halite company. It has not bought, just shown interest. A charter airline business, as the board of directors of Olivine believe that there is a good strategic fit between the two companies. Good strategic fit between the two companies. Both companies have the same level of risk because they operate in the same business. And this is very important to understand. Abbreviated financial statements relating to each company are set below. So abbreviated financial statements means extracts of financial statement, not the complete one, but the numbers which we need. So we read the numbers. Actually, some of the numbers are not really very important for doing question, but I try to read them so that it makes a picture in my mind, because when I have to write the discursive response, so I need to understand what this business is, the size and scope, etc. So sales 182, sales are less than half. So this is a smaller company. Operating profit is 43, which is and 21. Interest charges are huge. So 12.3, 10.2. So on like a very small scale of revenue, they have to pay this much of interest. I mean, when I say small scale of revenue, so profits will also be less. And from that profit, they have to pay almost the similar tax. So there's a debt. So I'm actually always thinking about that, why they are trying to sell or why they are trying to buy. So probably they have some issues. Anyways, net profit before taxation, 31.3, 11.2, company tax like this. After taxation, 25 and 9. Yeah, because here the ratio is not 3 times. Here the ratio is almost 3 times because of this interest. Dividend 6.4. Dividends they are giving very good. That's why they are actually having a lot of interest, because they are taking loans. And why they are taking loans? Because they are actually giving out everything as dividend. This is not something which is part of the question, but being a finance person, our eyes, they always go to numbers. They have huge loans and huge interest. And you see that they are paying 1/4 of their profit as dividend. Okay. 25 is the profit. They are giving 6, which is less than 25%. They are giving it more than 40% as dividends. Accurate profit for the year 19 and 5.6. Anyways, so we understand. So, I mean, these things we just quickly try to read. It gives us, it helps us to understand the picture. Non-current assets are 135 and 127. Very, very disappointing. It looks like that because they are doing double the revenue. This is doing 2 times of revenue, more than 2 times, 86 and 175. But non-current assets, there is not much difference. So it looks like that they have a lot of non-current assets. So another thing which comes to mind, that their interest expense was more, they took a loan. So it is possible that they have invested unnecessarily or heavily in non-current assets. Again, this is what I'm saying is not part of the valuation purpose thing, but I need to understand what is the target company, what they are doing. Net current assets, 65 and 3.2, very little current assets. So it means that their liquidity position is not really, I mean, if you see that the relationship between current assets is very little. Actually, what it looks like that they have invested a lot of current assets into their non-current assets. This could be a good strategy as well, because they've converted it into earning assets. Okay. Different approaches. This is a conservative approach, keeping a lot of cash and receivable inventory. This is very aggressive approach, keeping very little working capital, because working capital will be defined from here. So they are keeping very little working capital. Anyways, payables due after more than 1 year, 120, 104, 80, 25.6. Then you've got capital, 20 million of share capital. Each share is 50 cents. So it means that there are 40 million shares here. And it is $8 million is the share capital. So there are 16 million shares there. Okay. Then we have here, because retained profits, this is where it comes from the past, 60.1, 17.6. So this is profit from the year. And this is the total, 60.1, 17.6. And you've got here 80.1 total capital and reserves. And then you have a very important information, the price earning ratio of 20 and 15. A higher price earning ratio is a higher price earning ratio. It generally shows the trust of the market. It tells us that what are the earnings and how many times of the earnings is the share price. So for example, if their EPS had been $2 and their PE ratio is 20, so it means that the stock is valued in market at $40. So a 20, which is a high PE ratio, it tells you a higher level of trust in that company's future. People, they expect that this company is going to do good, and that's why it is putting this, it is pushing the share price up. So on one side, it is a trust about the future. On the other hand, it could be also you should be thinking like that maybe this share is overpriced. Maybe market is overestimating. Maybe there are some other factors which are pushing the price up. So I don't want to enter here. Anyways, it has pros and cons. PE ratio more and less. We discussed in video lectures. So although you do prefer businesses with high PE ratios and you appreciate it, but you have a caution or something, okay, that what is happening. Then we have here the board of directors of Olivine is considering making an offer to the shareholders of Halita Company of 5 shares in Olivine for every 4 shares in held. So for every 4 shares in this company, they are going to issue their own 5. So 5 in Olivine will be equal to 4 in Halita Company. Halit Company. So a very quick working, how many shares we have to issue? So Olivine will issue shares. So the total number of shares in Halit Company, they have a share capital of 8 million. So it means that their total number of shares are 16 million. And for every 4 shares, we are going to give 5 shares. So it makes me a 20 million. So 20 million new shares of Olivine Company will be issued to acquire this Halit Company. Now, if you ask me that what is the value we are going to give, so we will say, okay, 20 million multiplied by the market price of the share. Do we know the market price of the share? They have not given us. Can we calculate it? Yes, we can, because we have the PE ratio which is given to us. So market price of the share will be equal to EPS multiplied by the PE ratio. So I know the PE ratio is 20, which is given here, but what is the EPS? EPS will be earnings divided by the number of shares. So how much, and earnings after taxes. So net profit after tax is 25. So I'm not doing the question, I'm just making some numbers in my mind. 25. So 25 million is the earning after tax and preference dividend divided by the number of shares. 20, each share is 50 cents, 40 million shares they have. So 25 divided by 40. 25 divided by 40. 0.625. So their EPS is actually 62 cents, 0.625. And if I multiply it with 20, so actually their one share is $12.5. These are the real numbers which will become part of the solution. I'm not solving the question yet. I'm just telling you how when you read the question, how the things start going in your mind. And I have to offer 20 million shares. Multiplied by each share market price is 12.5 into 20. $250 million is the value you are offering. We will do it in the solution, but I'm sure we will come to this number. 250 million is the number. This is what you are offering to buy this company. What comes to my mind? Still not part of the question. Still not part of the question. What I see here, if I see this thing in real life, I'm going to offer $250 million, worth 250 million for a company which gives 9.6 only. 9.6 million. And I'm offering them 250 million. So how many years will it take me to recover my money? Actually, to me, it looks like a very stupid offer, very honestly speaking. Because you want to pay 250 million to earn 9.6 per year. So how many 9.6 you will make to earn your 250? That's under question. Yes, there could be some strategic reasons for which you are willing to pay. Let's see that. It says that it is believed that a rationalism of administrative functions. Actually, rationalism, when you say in business, like rational logic is something else. But rationalism means to decrease something. If I say, please rationalize this price, it means please decrease the price. So rationalization of administrative functions, they will become more, you will achieve some efficiencies. Arising from the merger would reap annual after-tax benefits of 2.4 million. So this is like synergy. So you are going to get synergy. So it means that your profit after getting this thing, the combined profit of the company, the combined profit of this company would be something like 25 plus 9.6 plus 2.4. This will come as synergies. But again, a question is, will you be able to achieve these synergies? Yes or no? That is another question. So always remember that whenever you are doing a valuation question, and in most questions, you also have to provide discussion as well. So what type of discussions do you do? You see, there are always some assumptions, and there are always some common issues which are related to a certain issue in a certain situation. For example, if I talk about traveling time, I say from point A to point B, I'm going to reach in 1 hour. And you will say, did you consider the traffic? Maybe the traffic will be more or less. So when we talk about the road trip and we talk about the cars and traffic, what comes to our mind, that if I say, oh, I'm going to reach there in 1 hour, provided that there is not some extra traffic jam. Okay. So similarly, in this type of situations, when you are doing acquisition, you say, I'm going to get this $2.4 million synergies. This is for future. So we'll say, we are going to get the synergies or not. So this will become part of discussion. So why I'm saying it like this is a very typical assumption. Like you said, that traffic jam is always a very typical assumption when you talk about travel time. So similarly, this thing. Then there is another issue which which happens is what is going to happen in the price earning ratio after acquisition. So there are always some assumption. They will say that price earning ratio will go up by 5%, will go down by 10%. So this will become my point of discussion. EPS will become my point of discussion. So usually these are the things which, I mean, you don't challenge these numbers because these are the existing numbers. And you don't have to comment on that. Based on this, you will come to some conclusion. The things which you will challenge are these ones, which are about future. Okay. Um, and they did not tell us because actually, if you pay attention to, this is also one of the discussion point which they have closed. They have closed you. For example, there is a good strategic fit between the companies because sometimes we start our discussion that maybe they are not strategically aligned, maybe they are their how to say goals and targets are different, they operate in different environments, they have different objectives, and probably in the long run it is not a good strategic fit. These are two different companies, you can't merge them. This is a one common discussion whenever you are talking about two different companies. Okay, so they say no, this is a strategic fit, so please don't talk about it. The second thing which we usually speak about, okay, these are two different companies. I've got my own risk level, you've got your own risk level. So might be my shareholders are not really interested in to operate in the risk environment where you are operating. So you say, no, you know what? Please don't talk about that as well. So there are some very typical discussion points in acquisitions. We speak about the strategic alignment, we speak about the risk levels, we speak about the synergies, we speak about the future expectations about growth. So these are certain points which are very common in every such situation, and this is exactly what happens in any other issue in life. Okay, in any other issue in life there are always some very typical points which are related to that scenario. um, I mean, when you talk about a job, you are thinking about changing a job or going a job. What do you talk about? You talk about salary, you talk about working conditions, you talk about the team, you talk about your seniors, you talk about the work culture. These are the common things which you talk about. I mean, there are not any other things. So very typically there are 4, 5, 6, 7 areas which are always need to be considered when you are thinking about accepting a job offer. So similarly, when you go into acquisition, there are some typical areas which we are talking about. I mean, these are actually, there are a lot more. By the way, we have started the discussion. I'm going away from the question. Please forgive me for that. Um, Whenever you do acquisitions, the things which we are learning in AFM and this mathematics which we do, the maths which we do here, or we are going to do now, it is just 10% of the entire process. It is just 10% of the entire process. Let me tell you. So don't think that if you have done valuation in AFM, you will become a very successful valuer. No, you will not become, because these numbers are just a starting point. The things which you have to consider, let's suppose, I'll just ask you one question. You say that there are non-current assets of 127 million. How old or how new these assets are? You don't know. What technology is there? You don't know. This company, who are the competitors and how strong those competitors are? How new or how old this company is? Maybe it has already achieved its, how to say, maturity, and it is already going into a decline phase. It's an old company. Is it a new company? Is it a growing company? Is it an old company? There are people working here. Who are the people who work in this company? Are you going to work with those people? What is the work culture? Company is very good. Numbers are very good, but there are 200 people who work here, and it has got a toxic culture, and it is very difficult to change the culture. I have to fire everyone, which is not possible for me. I just stray away. So sometimes the people who work there, they become challenged. In which environment it operates, what regulations they have to follow, what type of lease agreements they have entered into. Those contracts, onerous contracts, maybe some binding contracts, do they have any legal cases there which are going on with them? What is their customer satisfaction? What is their image in the market? Do people like to work with this company, or does this company has have a bad reputation? So there are 1 million points which you need to consider in real life for valuation. These numbers are just some basics which managers they keep in their mind as the starting point, and then negotiation will happen. Negotiation will happen. I just said 250 million. And then you suddenly find out news from someone that this company has got very little current assets, and they are actually, if they need someone to rescue them. If they don't sell the company or part of the company, and if they don't insert cash into the business, probably they are going to go for a bankruptcy because they have huge commitments, although they are profitable, but they cannot meet their obligations because a big part of the loan is due very soon, on which they are paying interest. Oh, now that actually makes my negotiation point stronger. I'll say I'm going to give only 150. So just like in real life, when you buy and sell your assets, so it depends that in how much, under which conditions are you selling your asset. Can you wait, or do you really need cash now? So if you really need cash now and somebody finds out that you are looking for cash, they will give you half the offer. And this exactly this thing happens in business as well, that why they are trying to sell the company, or if I'm going to acquire. And the same opposite thing happens the other side when they find out that they really need me, so they will say I'm looking for 300 million. Just like if you know that you have a piece of land here, and there is someone who has a piece of land there, they've got a house here, and they say, please give it to me. And you double the price because you know that they already are living here and they need to make this land with them. You say, okay, you know what? I need 300. So the real life deals or the prices will be agreed depending on many other factors, starting from culture, people, products, quality of assets, brand of assets, technology they use regulators, lease agreement, long-term contracts, customer cases, people, their litigation, customer satisfaction, customer loyalty, and the life of the company. Is it old? Is it new? So many things will be done, and then finally a number will be arrived in real life. But as for the exam is concerned, we talk about what comes to hardcore numbers. Okay, so 250 million, I calculated a number. Um, that's just mathematics. That is just maths. Now we see here what are the requirements. I'm sorry, I just deviated from the topic, but I thought you should know that. Okay, so 2.4 million are the expected synergies. The total value of the proposed offer based on current share prices. So part A. So calculate number one, total value of the proposed offer. I actually have done that 250 million. I will do it again. If it was not wrong, I will check it again because I just did it quickly. The earnings per share of Olivine following the successful acquisition of Elite, which means that EPS, the new EPS, because old EPS you will calculate from these numbers which are given. But once you acquire it, then what will happen to the EPS, the new EPS after acquisition, and the share price of Olivine following the acquisition, assuming that the benefits of the acquisition are achieved. These benefits are achieved, and that the price earning ratio declines by 5%. And then they say that after acquisition, so what they're asking you three things. Number one, how much offer are you going to make? And if that offer is accepted, then after acquisition, what will happen to the EPS of the company, and what will happen to the share price of the company? Share price of Olivine. So all of this is about Olivine, the parent, the predator company. So let's first calculate the offer. Okay. So we know that. So I'll call it A1. Let me put it as a small one because they have put it like this. Okay, A1. A1 is about proposed offer. Okay, what happened to my fonts? I usually use Calibri. And let's make it slightly bigger so that you people can see it. Even bigger, okay? So that everybody can see it easily. Okay, so proposed offer. So what is the offer? Offer is um, 5 shares in Olivine for every 4 shares in Helit. Okay, this is the offer. And they asked us how much is the value. So Helit shares are 0.8, 8 million. 8 million times 0.5. You can do it quickly because I am explaining it in the class. So I have to, divided by. So they've got 16 million shares. So offer is offered shared or 5 for 4. So 16 divided by 4 multiplied by 5. So the total number of Olivine shares which we are going to issue are 20 million. Okay, this is 20 million. Now, market price of uh, Olivine share. This is what I need to calculate. I know that I have to give them my 20 million shares. So what is the price of one share? We know that their price earning ratio is 20. Their PE ratio is 20 and their earnings are, okay, I need it later. First, I need to calculate my EPS. And for calculating EPS, I need my earnings. And which earnings I should take? You should take earnings which are after taxation and before any dividends. So remember that earnings mean earnings which are, available to be distributed to the ordinary shareholders. And these are 25 million. 25 million. Because you cannot call this earning because you still have to pay tax. And you don't call it earnings because you already have paid some dividend. So this is the number which we use always in the calculation of EPS. So I will assume that Olivine earnings are 25 million and number of shares of Olivine are, this is 50 cent for one share and there is a 20 million of capital. So you can say that number of shares will be 20 divided by 0.5. I put it here is equal to 20 divided by 0.5. So 40 million they have shares. So EPS will be earnings divided by 25 divided by 40. So you've got 25 divided by 40. 0.625 cents is the EPS and price earning ratio is 20. So share price is actually equal to EPS multiplied by PE ratio. So I multiply this EPS with my PE. So one share price is actually $12.5. So before any acquisition, Olivine Company share is valued in market at $12.5. And how many shares are we going to offer? We are going to shares to be offered are 20 million. So value of offer You can do it in your way of, in one line or in paragraph, whatever. I'm just putting these numbers so that it becomes easy for me to calculate. So 250 million is the valuation. This is the offer which you have made to acquire this company. So this was our part one. It says the total value of the proposed offer. Let me put it in red. This is answer number one. Then you have your A2. A2, it says the earnings per share of Olivine following the successful acquisition of Elite Company. That, okay, if you acquire this company, then what will be the earnings after acquisition? So we say that earnings post-acquisition. Post-acquisition EPS. Post-acquisition EPS. So how do we calculate it? You will find out post-acquisition earnings. And how much are post-acquisition earnings? Post-acquisition earning means that two companies, they become together. And if they are becoming together, let me know, because I just took it down before I started here. I'll just take it somewhere up. So what is going to be the post-acquisition earning? So it will be the total earning, the combined earning of two companies, which mean 25 and 9.6 and 2.4. Those benefits which you are going to achieve as a result of rationalization of administrative functions. So 25 plus 9.6 plus 2.4. So I did not take any number from anywhere else. 25 plus 9.6 plus 2.4. So this is my expected post-acquisition earnings. And then you say post-acquisition number of shares. They had 40 million before. So it is 20 million of capital. So they had 40 million shares before. And they are going to acquire this company by offering 20 million new shares. So it means that the post-acquisition situation, in post-acquisition, remember that they had this 16 million shares. So after acquisition, to buy the 16 million shares, they are offering 20. So your combined shares or the shares in the combined company will be 20. This had 40 billion. 40 plus 20. You will ignore this 16. 16 is no more there because 16 you replaced with 20. Okay. So old shares in Olivine company were 40 million. Plus the new shares Olivine company is going to issue is 20 million. And do not write 16 because 16 is no more there. To remove those 16, you are actually offering 20. So your total number of shares will be 60 million. And then you can say my EPS after this thing is 37 divided by 60. That is 0.6167. So your EPS before, this is part B. So EPS before is 0.625 if you pay attention. So for Olivine company, before acquisition, the EPS was 0.625 and now it is 0.617. So there is a very little difference in EPS. Very little difference in EPS. But remember that when you are telling to someone or when you are discussing this question, this is an absolute number. This 60 is going to happen, but this is under question 2.4 because you assumed that I will rationalize or I will save my cost and I will get 2.4. If you don't achieve this 2.4, this is always, whenever you will have synergies in all acquisition questions, you should always challenge the synergies because synergies, this 2.4 million synergy, if in real life, it is actually based on long assumptions. So HR department will come with their own assumptions. You know what? I will have a combined HR. Logistic will come inside. You know what? I will have a combined logistic. Admin will come. I will save there. So this 2.4 million is actually a sum total of 20 actions which you are going to take. And some of those actions are actually valid, but some of those actions are not realistic. So it is quite possible. So whenever somebody comes in and say, if we join together, we are going to save 2.4 million, you say, let's sit down and open up the list. And let's see what realistically you are assuming. And if this number is okay or not. And if it is a conservative estimate, or are you overestimating something? So if we take away this synergy for a moment, let's suppose the guy who is making this proposal, he is very tempted to do this deal, and he comes up and says 2.4 million. To be very conservative, I say there is no 2.1 million. I don't believe you. So I'll say if there are no synergies, then what will happen? If there are no synergies, the EPS will be 0.57. From 0.62, EPS is going to drop significantly in the absence of any kind of synergies. So this is a very valid point. You will always question and always consider it, that these synergies I have to challenge. And by the way, if EPS falls, because 0.625 to 0.577, you know what percentage it is? 0.625 minus 0.577. So 0.048 divided by 0.625 times 100. There is a drop of 8% in earnings. Earnings per share, EPS, earnings per share. Shareholders usually, I mean, when we are taking any decisions about capital structure, okay, let's take some debt and pay off equity. Let's offer some equity, pay off the debt, changes in capital structure, because they are going to affect my EPS, number of shares. So we always say, okay, let's see what is going to be the impact on EPS. Let's start a new project. Let's see what is the impact on EPS. So in real life, EPS is a very sensitive thing. And we usually do not take any decision which is, which has a potential of impacting my EPS negatively. Because this is the first thing the shareholders are looking at. Investors, they are looking at EPS. So two things you will always try to protect in financial management. One, the share price, and second, the EPS. Two things. We don't compromise on we don't take any decision which would potentially bring down the share price, and we don't do anything which will potentially bring down my EPS. So anyways, this was part B. Part 3, the share price of Olivine following acquisition, assuming that the benefits of the acquisition are achieved and that the price earning ratio declines by 5%. So now A3, it says that you have to calculate post acquisition share price of Olivine. So share price, okay. Share price is equal to my EPS multiplied by PE ratio, okay. This is the formula for share price. And EPS, and it says that EPS, you should assume that the benefits have been achieved. It says that you assuming that the benefits of acquisition are achieved, which means that this 2.4 million achieved, which means that taking this number, so forget about this. So you assume that these benefits are achieved. Okay, so I take EPS at 0.617, and then I have to see my PE ratio. And PE ratio, it says that PE ratio, it drops by 5%. Now that is another forecast. You say that, you know what, there is a possibility that price earning ratio will decrease. Why? Because this is 20. I was 20. He was 15. So we are combining it. So something which will come up, potentially it is not more than 20 and it could not be less than 15. Logically, the number has to be between 15 and 20 because we are seeing your PE and my PE. So if your PE is 15, and if you come to me, how come my PE will become 22? What are you bringing to me? You are bringing 15. You are adding your 15 to my 20. The average, the total cannot be more than 20. Okay, it makes sense. Or if I bring my 20 to you, I can pull you up from 15, but I cannot bring you down to from 15. So the new PE ratio should be between these two. And how much it is? They say it decreases by 5%. Now, I have some serious concerns here. Um, it is 20 into 0.95. So they say that your PE ratio will decrease only by 5%. So the new PE ratio will become 19. My old PE ratio was 20. I was very happy that my share was priced 20 times more than the earnings. Here it says that only 5% drop will happen and the new PE ratio will remain 19. I have serious concerns on that, by the way, because this is a company which does not have very good financials and it is coming to me. So high my EPS is just 5% decrease, probably 20% decrease, maybe more than that. Anyways, we assume that 5%, but you have to challenge it in exam that this 5% assumption, the decrease in the assumption about 5% decrease in the PE ratio, it requires some serious investigation because the Elite companies, their own PE ratio was only 15. And when it come to us and they bring their financials and, it does not make sense much. Anyways, the new share price will be 0.617 into 19, which is 11.717. So it looks like that your share price previously, it was 12.5, I think. Yeah, share price was 12.5. After acquisition, your share price, it drops down to 11.717. And it was supposed to happen because you are bringing in a company which has, um, you know, which is not as strong as yours. And you are giving, by the way, 5 shares of yours. Anyways, this is one, two, three parts from this question number one. Then we have to do part B. It says calculate the effect of the proposed takeover on the wealth of shareholders of each company. So company like Olivine and Elite, what happens to their shareholders' wealth? Oh, that's very simple. What is the wealth of Olivine? Olivine, if I see, Olivine had 20 million shares. Sorry, 40 million shares. So I can calculate like this. Uh, Before acquisition, there were 40 million shares. Each share was 12.5, and they were living a happy life with a total wealth of 40 times 12.5. I will do this question in a much more serious way. Right now, I'm just putting the numbers in my mind. Now they are still 40 million, and their wealth is share prices 11.71 or 772, or let's call it. So 40 times 11.72, 468. It's actually 469 because 468.8 or something. Let's call it 469 minus 500. So these people are going to lose this 31.2 million. The wealth of Olivine Company, which is the predator, the buyer, their shareholders are going to lose 31.2 million in wealth for taking this decision. What happens to Hilti Company? Hilti Company, before, there were 16 million shares multiplied by the share price, which we have not calculated. But later on, when they come in with 20 million because they will give up their 16 million and they will get 20 million shares, and each share will be 11.72. This one, the same price, because they become part of my company. So 11.72 times 20. So their wealth after acquisition is 234. What was the before? You have to calculate their EPS and PE ratio. You can do that, by the way, because you have the data. So find out the EPS. Their PE ratio was 15. So what is the EPS here? I can do it very quickly. I'm just showing you how to do it, okay, in exam as well. So um, their earnings were 9.6. Yeah, net profit of 9.6. So their EPS I can calculate as 9.6 divided by number of share was 16 million. So 9.6 divided by 16 million shares. So 0.6. 0.6 was the EPS, 15 was the PE ratio, 15 times 0.6. Their share price was $9. And they had 16 million shares. So 16 times 9, 144. So they were 144 million before, and they are 234 million after. So it looks like that everything $90 million. In terms of percentage, 90 divided by 144, it's 62%, 62.5% increase in their wealth. Oh my goodness. So it looks like that the other party, which is, I mean, they are lucky that somebody has come and proposed them, actually. I mean, they're getting a very good offer. They were 144 before, and after acquisition, their wealth, it becomes 62. You know why? Because they are getting 20 million shares. What happens with them? Number one, they are giving up 16 million shares and they are getting 20, so 4 million extra shares. And their own share price was 9, but the combined company share price is 11.72. So, I mean, this is not a deal which can be offered on the table. Does it make sense? Of course, you do have to give them something more than 144. You cannot tell, I'm giving you 144, take 144. No. In order to materialize this deal, you have to give them some benefit so that they feel that they have something in this transaction. So they are willing to give up their shares, give up their control, give up their company, and come in and become a minority shareholder in your big company. Right now, they are majority shareholder, they are controlling and they are enjoying. They've got big rooms, they've got big backs. But once they come part of your company, they become minority shareholders, they will lose control. And they have to sit down and see. So to sacrifice on all those things, that power, you need to give them something. So I need to make them offer, but this offer looks too much because they are losing. So at least I should make it zero. I should offer something which makes it zero. So, I mean, I have to give them, I want to maintain them at 500 minimum. Okay, you remain at 500. And this 31.2 million I should take out from this 90. So somewhere close to 60, because in loss, nobody is going to make transaction. I cannot go to Olivine shareholders and say, you know what, we are going to buy the company, you will lose the money. They said, don't buy the company. I don't want to lose money. What sense does it make that we will buy a company, you will lose money? So at least I should give them something. Or if I'm not giving them anything, then at least I can put them as it is, as they were before. Even if you make it zero, they will not be happy. They will not agree to this transaction. You do have, so the total you need to see, what is the total benefit in this transaction? And that total benefit should be split. That total benefit should be split between the two companies. So for example, if I come up here, effect of the proposed takeover on the wealth of shareholders of each company. You see what, if I see the company old, before Olivine was 40 million shares, each share was 12.5. Okay, it looks like that I'm not going to type in Excel. I've taken a lot of time in discussion, so this is the final calculation. Olivine was 500 before, and this Elite company was 16 million. Each share was 9, and it becomes 25. Oh. $144. So individual value, these two companies operating separately, their total value was 644. So this was working here, a 500 company. This was working here, a 144 company. And then you said, let's put them together, maybe making a bigger circle. So what is the value of this bigger circle? The combined company. The combined company value is now 40 million shares before and 20 million shares new, 60 million shares. Each share is valued at 11.72. So 60 times 11.72, 703 million. Oh, so value is being created. So this particular transaction is going to create value. So if you see that, how much wealth is created? 703 minus 644. So 703 minus 644, the wealth is created as $59, 59 million. Now, this is very interesting now. It is getting interesting, okay? That is for sure that, okay, why you have got a bigger number? Because you got a bigger share price. Why you got a bigger share price? Because you assumed only 5% of this drop in PE. If you said PE had dropped by 20%, then you would have made it with 0.8 and, something different results will come in. Anyways, we assume that 5% drop happens. So there is a benefit in this deal of total 59 million. So you remember we were just calculating the benefit transfer to Elite company, and we said Elite company will be making plus 90 million. You have a total 59 million benefit. How are you giving 90 million to Elite? Because the other company, you were giving a 31 million loss. So Olivine, you said, I will take out 31 million from your pocket and I will put it into the pocket of these angels sitting in Elite company so that they can enjoy a 90 million benefit out of a benefit of 59. Does not make any sense to me. So they ask you two questions. One, what is the shareholder impact on shareholder wealth of Olivine company? Minus 31 million. What is the impact on shareholders' wealth of Elite company? Plus 90 million. How did we calculate? I showed you. Elite company shares 20 with the new price 11.72. The new number of shares into the new price, old number of shares into the old price. And then what is the total impact of this transaction? These two companies, total 644. This single big company, total 703. Total wealth creation 59. That should be distributed fairly. You can say minimum, you become zero, you take 59. Okay, I don't eat anything, you eat everything. The maximum I can go is 0.59. This also is a very big compromise. Possibly you should be saying something like some percentage, total benefit 59, because I have to oblige you to sell your company. So I'm giving 70% to you and I'm keeping 30% myself. Let's do like this. So this will depend on negotiation. This will depend on all who has the desire to buy what. Discuss your result A, B above and state what recommendations, if any, you would make to the director. So my findings are, discuss your results. My results are that the parent company, they attack the buyer company, Predator, Olivine company, their shareholders are losing 31 million. The target company are getting 90 million. The total benefit from the deal is 59, and you will explain how did you calculate 31 and 59 and so on. And this is based on two big assumptions. Number one, that you will make a synergy of 2.4. And number two, that the decrease in the P is only 5%. These both are under question mark, and we need to see if these are achievable or not. So based on the assumption that you achieve these two targets, you still have you are creating a total wealth of 59 million, which should be distributed based on some base in such a way that the shareholders of Olivine company, they should give approval to this transaction. Otherwise, they would reject. It is true that you need to provide some incentive to the target company shareholders so that they should be willing to sell the company. So they are expecting some benefit more, from 59 million, they are expecting some, a bigger share. So you probably end up making a suggestion of maybe a bigger portion from 59 million to the shareholders of Elite Company and a smaller portion to Olivine, because Olivine is approaching, Olivine is interested, Olivine is expanding. So Olivine actually has to give something. Okay. So this is interesting question.